Hello everyone and a very warm welcome to today's stock markets update for Wednesday, March the 19th, 2025. As you know, we are tracking the markets using primarily the Elliott Wave, where we believe the markets are in this smaller fourth wave with a final fifth wave to go to complete a larger third wave, then a much larger fourth wave than what we just experienced over the last month, as if that was not scary enough, and then a final fifth of a fifth wave to complete most likely the bull that started all the way back in the 1930s. However, we also, of course, apply the weight of the evidence approach. We want to make sure that we are not only looking at one tool, but are using as many tools to our advantage that are available online, and also, of course, look at other pundits. I've shared with my premium members the recent video from Larry and Williams, I believe, and it was really bullish. He really said it's rally time, and he provided also a lot of evidence on why that was. So when he speaks, I think you should listen, and that is what we are doing. And we're listening to the price charts, because price charts are an objective way of analyzing the underlying conditions, as price is the aggregate opinion of all market participants at any given moment. But again, even if we use everything that is available, we can never be always correct. We are 70% reliable. Why? We're humans. We make mistakes. We sometimes misinterpret things, and that misinterpretation can lead, of course, to a mistake. So we're not prophets. Nobody is. And if you're looking for certainties, you will always keep on looking, because the market is probabilistic, meaning it is based on if-then scenarios. If price goes below level A, then it will go to level B. If price goes above level B, then it will go to level C. All right, so let's see. Always remember to take care of your losses, because losses can lead to even bigger losses if you don't manage them properly. As you can see here, that even a 30% loss has to be recouped with a 43% gain before you're back to even break even. All right, gains need to make up losses by a lot. And last but not least, there are many ways for you to use our services to your advantage. Please do so, and I'm gladly here to help. So now let's assess the charts. Computer is a little bit slow today. That's okay. Here we go. We're starting off with the Dow Jones. I'm simply going in alphabetical order as it is listed on my platform, stockcharts.com. This was the alternative wave count for the 3 and the 4, and we had to hold above 42,175, the actual low here for this wave 1. Well, we broke above it, so we can now take the alternative wave count off the table. There we go. And as I said to my premium members before, never bank on this little fifth wave here. Do not, because we can easily, as you can see, move this fourth wave from here to there and be absolutely correct. Because as you know, in this case, we were counting corrective waves at up days, but that method doesn't work all the time. All right, nothing works all the time in the stock market. As much as we try it, as much as we love it, it's not going to happen. I'm currently working on a updated trading system in TradingView, and even that one with AI involved cannot give us 100% winning trades. The winning ratio is about 60%. That's as good as it gets. However, it beats buy and hold. My trading systems will create about 20% return, and the buy and hold will create about 11%. That's the difference between active management and just sitting, waiting, and hoping. So most likely we're in this new impulse, contingent, of course, on holding above last week's low. But this starts to look good. We have made a higher high and a higher low for first. All right, that's really good. I like it. We're soon probably going to get buy signals, all the good stuff. So this is now our preferred wave count. The alternative being just a bounce and a lower low, but that would not fit with the larger, bigger picture Elliott wave count we have for the Dow Jones. That we've just completed a irregular expanded flat wave 4 here in red, and we should now be on our way to about 47,500, potentially 52,000 for this wave 3, and then of course the larger wave 4 and then 5, just as I showed you in the introductory slide. All right, that's what we're looking for. This is the ideal path, contingent on holding above key price levels. For now, we need to hold above last week's low to allow for this rally to 47 to about 52,000 to materialize. If we break below last week's low, we can easily revisit the 38 to 35,000 and still move higher, but it increases the odds it is not a impulse anymore. But then we're really starting to look for a ending diagonal, which is kind of what I'm showing here. Extensions are more akin to that of an ending diagonal than a true impulse. But remember, we've still been overbought, and that always leads to higher prices eventually. Overbought on the money flow. The MACD made a higher high. So all that good stuff is still there. This still looks like a very strong long-term uptrend. This is a monthly chart, by the way. So as you can see, we're well above the rising 2-month, 50-month, 200-month, and Ichimoku cloud. So the bullish trend is still firmly intact. Moving on to the NASDAQ 100, yet a higher high, but once again it's trying to poke its head above the first warning level for the bears. So this is option 1. We cannot yet delineate between option 1 and 2, which I will show in a moment. And darn stock charts, it keeps of course messing with my target zones. There, no, not me, this one, there. So these are of course not set in stone. As you can see, of course, stock charts messes around with them. This is really a just a exemplification of how things can progress over time. This is neither correct in time nor correct in price, because we do not have even enough waves in place for this wave 1. So this is just really an example of how we can foresee price move over the next few weeks to months. Remember, we got the most oversold MACD in the NASDAQ 100 history, so that is never a bad moment to buy, honestly. And though I don't give any buy and sell recommendations, we have, of course, shared a plethora of indicators and methods that told us, you know what, this is starting to really look like a low risk, high reward setup. There's never no risk, right? The market can crater at any time, but there's always low risk, and this is as low risk as we can get. We have a couple of 100 to 1,000 downside points at the best, 1,000 meaning going all the way to the August 2024 low at 17,000, and we have of course huge upside potential into the 22.5 to about 25,500, somewhere around there. Okay, so that's your downside risk, 18, maybe 17,000, as I mentioned. The August last year low, this is your downside risk, and that is your upside reward. So this is option 1, that we have completed wave 4 already, and we're now on our way for wave 5. And then of course option 2 is that the wave 4 is going to subdivide. Again, it depends on how do we interpret the price action from December into February. It's 3 waves lower and it's 3 waves back up. So this could be, as I showed here, simply a irregular expanded flat 3, 3, 5. We got 9 waves lower into last week's low, which is part of a impulse. Impulse moves in 5, 9, 13. So it can be a 3, 3, 9 as well, or a 3, 3, 13. Okay, so we got 9. So this is then an A, B, C. This counts really well as a ending diagonal. I definitely got wrong-footed here by this tiny decline for this potential green wave 4 versus the very large wave 2. But you can see this looks very good as a diagonal. So with 3, 3, 5, and then wave 4 is done, versus that no, the last 3 up was still part of an ending diagonal, because ending diagonals are a 3, 3, 3, 3, 3 pattern, right? 5 threes in a row. So the last 3 can still be a wave 5, because wave 1 is 3, wave 2 is 3, wave 3 is 3, wave 4 is 3, wave 5 is 3. So that's a little bit of a tricky situation we're currently in. Okay, so this is simply the 2 possibilities there are. There is honestly, in my humble opinion, no different possibility than these 2. So both are looking higher. Even the bounce here to about 21,000 plus or minus 400 will then look to that 17,000 level, the low to mid 17,000s. And then we'll simply have a protracted wave 4. It wouldn't surprise me, since wave 2 was of course a whole year long, so this can last quite a lot longer, with the ideal downside target somewhere around 18,000. That is the 76.4% extension, quite normal for a 4th wave, and as well as very close to the 38.2% retracement. retrace. That's the red box here with the upper end 23.6, the lower end 38.2. Everything is really been spelled out, and yesterday visualize it and to also show it to everybody who's going to look at it later on YouTube. A, B, C, very, very possible. Okay, I'm not going to say this is not going to happen, but of course the B wave is looking higher to about 21,000, and of course the impulse is looking higher, but the impulse is simply looking much higher than the bounce. That's the difference. As of now, I still have too little information to be able to delineate between these two options. But for now, both options look temporarily higher, be it for the wave 1 of 5, as I shared here, or be it for, of course, the B wave of wave 4. All right? That's really the difference. So both are looking higher. One will eventually lead to new all-time highs. Here we could just expect a retrace. And of course, if we start moving higher and higher above 21,500, it starts to increase the odds this is not a B wave. All right, moving on to the semiconductors. Very close to overlapping with 47.76. If it does so, then we will not see a 4-5, but it's still possible. It is still possible. As of yet, not enough information available. I must say this starts to look like 5 waves up. 1, 2, 3, 4, 5. Okay, but too little price data yet to know if we're going to see a 4-5, but above 4776, and we're going to go to 5700. Then this was a ugly, extremely complex correction. Then this was A, and this was B, and this was C. All right, extremely complex of a, I would say, flat type corrective pattern. Most likely, I would say this is almost more like a zigzag lower, a zigzag up, and a zigzag down. Ziggity zigzag zog. Ugh. Very bad, but we know soon enough. 47.76. Above that one, I'm going to look for 5,700. If we, of course, drop below last week's low from current levels, then we're going to look for a little bit lower. It would say into the high 3,000s a bounce. And honestly, I'm going to stick a fork in this market. The semiconductors, not the other markets. We treat every single market by itself. All right, moving on down the ABC order, S&P 500. Also here, the ABC path that can target still into the low 5100s. We made a higher high, I believe about an equal close. And again, we need to break above at least 5782, ideally above about 6,000 to start to suggest that we can put a fork in the current decline. With the B wave target around 5,900 plus or minus 100, and then again the C wave target here. So this is option 1. I cannot delineate between this option and of course the bullish option as I shared for the NASDAQ 100. All right, too little price information available at this stage. And as you can see, the wave 1 of the new impulse will top right at the same level as the B wave. Trust me, the market will keep its intentions hidden for as long as possible. And then we'll get this wave 2, which will be akin to the C wave. But of course, the C wave will go to 5,100, but the second wave will stall probably somewhere around 5,600. That's the difference. So from a bigger picture perspective, this is the ABC. And again, we can easily go to 5,100 for this fourth wave. It's completely normal to do so. Then we have the third wave at the 100%, the fourth wave at the 61.8. And then, of course, we're going to see the third wave to 7,000, 7,500 plus. All right. This path, very possible. I cannot say this will not happen. And neither can I say that, of course, this path will not happen. So for now, both are equally valid. For now, both are still looking higher, contingent on holding above last week's low. But it starts to look good. As you can see here, the 5-day simple moving average is holding as support. It's turning back up. We're back again above the 10-day simple moving average. That has not happened since the February high. So all things considered, this still looks very good. And then, of course, this got, discombobulated a little bit. We have here our impulse higher, all right, there, something like that. And then this should go there, something like that, all right, something like this. We'll see this rally materialize into the 7,000s, all right. There, we have it, something like that. All right. IWM, we don't know yet if we're going to see a 4 and a 5. Don't think so. First off, we have a buy signal. We do need to get all the way above about 217, 218 though to know that the fourth wave is not going to happen. But this starts to look better. But again, I don't know yet. I cannot tell you. We need to break above last week's low to trigger this wave 5 and not go above 217, 218. Trust me, the market is going to take its sweet time to tell us if this 4 or 5 sequence is going to happen or not. If we see 5 big waves lower, 1, 2, 3, 4, 5, stick a fork in this index, we will get a bounce and then much, much lower prices. All right. If we only see 3 waves lower, do not stick a fork in it. I think we can still go to about 253. That's the alt wave count for stick a fork in it, 3, 4, 5. And we'll see 253 based on our preferred wave count, 1, 2, 3, very, very, very deep wave 4. All right, let's look at some other interesting indexes and charts. This is the high yield bonds. All right, the high yield are junk bonds and they trade as stocks. They're very high risk and oftentimes much more volatile than the stock market. And as you can see, it's back above its uptrend line and it's barely budged. While the S&P 500 created a lot, 10% down, the junk bonds didn't do bad at all. So this is a good positive sign. They really tend to move in tandem, as you can see. All right, junk bonds trade like stocks, and they're really risky. Okay, so if there's a risk appetite, the junk bonds will do well, and that of course means the stock market will do well. How we're doing on bullish percent index. This is the bullish percent index for the NASDAQ 100, and you can see here we bottomed just below 30. And if we do that, it's often very close to a very good sustainable bottom. All right, we did it here in August. All right, we did it here in April. We did it here in October 2023, almost here in March, and again here. And this is, of course, a bear market. Not sure if you want to compare bear markets, but also here below 30 often leads to a pretty decent bounce. And in a bull market, once again, you can see here, March 2021. And of course, March 2020, we went all the way to 0. And from 0, the only way is up. But you can see really that we can expect higher prices with a reversal from below 30 to back above 30. So also this supports higher prices. The AD line, we had the downtrend here in place since the February high. Of course, still massive negative divergence, but we've broken above this downtrend line. We did this already on Monday. Yesterday, we held the downtrend line and we're blasting off. All right. Breadth leads price. More stocks are advancing than declining. Bullish. So, all right, that's great news, do you say? Well, that's holding this trend line. What does that matter? Well, we'll look back all the way to about 2022. I can show you a lot more data going back all the way to 2009, but for brevity and of course to make it legible for you when you see the screen, is the idea here, every time we break above these downtrend lines, a new uptrend has started. Every single time. All right, every single time it happens. There, etc. Okay, so downside risk is minimal, upside reward is pretty good. It's not the start of a multi-decadal bull market. You know, sometimes it happens and we see, of course, smaller rallies, and other times it happens and we see really big rallies, like here at the November 2023 low, or here, of course, at the May low after the April correction. We didn't see anything here actually in August, because in August we actually had no downtrend. We actually had positive divergence. Interesting, huh? That was also a signal we would go higher. So everything considered, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 previous signals over the last, I would say, 1 year, 2 year, 2.5 years, and all of them led to low risk, high reward. Well, that should tell you quite a lot. How we're doing on the PMO Bio indicator? Well, I showed you that once this thing has bottomed out at 0 for a while, so here you get very good low risk, high reward setups. Here, for example, September 2022-ish, still was a little bit downside here as well in May, but this was a bear market. But here in April 2020 and September, you got upside, a little bit downside, and then look at the upside. So also here, low risk, high reward setup. Zooming in, you can see it even better. We've been flatlined for quite a while, all right? And now we get a renewed buy signal. So this looks really good. This also supports higher prices. Remember, this is the weight of the evidence approach. And then we're going to look at our medium-term indicator. So far, so good. Remains bullish. It is at 457, and it needs to stay above 426. So that's also still good. It's been on a buy since, I believe, Monday. So far, so good. Let's look at the IMO indicator. It looks good. Made a higher high, confirming today's price action. This looks really bullish. And we had, of course, our VIX buy signal already earlier this month, and the S&P 500 buy signal also earlier this month. It failed twice or three times before during the correction. Again, showing nothing works all the time. Everything works 60% of the time, right? Something like that, or 60% of the time, it works every time. Good buy signal, and this is not a good buy, but it's a good buy signal. And of course, here we did not get really a buy signal. We had no closes below -40 and below the Bollinger Band, but the current price action in the NIMO is very, very positive. That means if we look at the McClellan oscillator for the S&P 500, we also see a higher high. We're back to positive. We just bottomed here, I would say, in the buy zone. This is not yet the zone where you throw everything at a kitchen sink at it, as we had, for example, here in December and here in April and here in August. But this was still in the buy zone, so that's good. And so the summation index, which is based on the McClellan oscillator, is starting to turn back up. We just had a sell signal. Did not get extremely oversold at all. It's quite, on the RSI5 we did, but not the actual summation index that should go to -500. That's really good signals, as you can see here. So all in all, under the hood, this was quite mild, believe it or not. It was more a correction in price than a correction in underlying market breadth. So already starting to turn back up, supporting higher prices as well. So all in all, again, the weight of the evidence really starts to suggest that we should look for higher prices. From a Elliott Wave perspective, we don't know yet if it's going to be, just a bounce, or if indeed the next run to new all-time highs has started. I wouldn't be surprised if we see literally a V-shaped recovery to new all-time highs. But my opinion doesn't matter. We have to stay objective. We have to remind ourselves that anything can happen based on new information that becomes available to the markets. So for now, we're going to look higher. And then we'll see if we get a pullback that will go below last week's low, or if we're done and we'll just see a slight pullback for a couple of days, and then we move back up to new all-time highs. That's the two alternatives. Market breadth and other indicators support that. Other people are seeing the same. I mean, I keep sharing all that stuff. I think you really get the bottom line. This is as good as things get from a low perspective. Take care, trade safe, and I'll see you all later this week.